Audit sampling is defined as the application of an audit procedure to less than 100% of the items in a population. Why does an auditor sample? There are two easy answers to this question. Auditors are willing to sample to 1, save time, and 2, save money. Auditors are willing to accept some uncertainty or risk from sampling just to complete the audit on time at the lowest possible cost. If saving time and money is not justified, then the CPA would examine 100% of the items in a population, a choice an auditor seldom makes due to time and cost. Auditors are willing to accept the uncertainty or risk of sampling to save precious time and money. There are two general approaches to sampling: statistical or non-statistical. Statistical sampling utilizes the laws of probability to select and evaluate the sample for the purpose of reaching a conclusion about the population. Non-statistical sampling allows the auditor to consider sampling risk without using statistical theory to measure the risk. Which method is most acceptable according to auditing standards? Statistical or non-statistical? Don't be fooled. Both methods are acceptable by generally accepted auditing standards. In fact, be careful here. Don't make any assumptions that statistical sampling is better than non-statistical sampling. Understand that both sampling methods are allowable by the auditing profession. Also, understand that both statistical sampling and non-statistical sampling require the auditor to make judgments. Both methods require the same audit procedures, and both methods involve risk. In other words, both methods, statistical and non-statistical sampling approaches, provide the auditor with sufficient, competent, evidential matter. There is only one major difference between statistical sampling and non-statistical sampling. Since statistical sampling uses the laws of probability, statistical sampling allows the auditor to mathematically measure the audit risk and the sufficiency of the audit evidence obtained. All of the risks of auditing that are not due to sampling are called non-sampling risk. Let's consider non-sampling risk first. Examples of non-sampling risk are human mistakes, failure to recognize errors, applying inappropriate audit procedures, or misinterpreting the audit results. Notice, non-sampling risk occurs because the auditors are human. They make human mistakes. Auditors can reduce non-sampling risk through better audit planning, training, supervision and review, and applying overall firm quality control standards. All of the risks listed above can occur whether the auditor samples or not. Now, let's go back to sampling risk. What is sampling risk? The risk that the sample is not representative of the population. How much sampling risk is acceptable? You know the answer. It depends on the auditor's judgment. Understand that auditors plan to keep sampling risk low. The CPA hopes that the sample is a good representation of all of the items contained in that population. Based on the findings of the sample items, CPAs project the sample results to the entire population. Sampling risk arises from the possibility that tests of controls or substantive tests performed using a sample may give the auditor different conclusions than the auditor would find if they had examined all or 100% of the items in the population. Sampling risk varies inversely with sample size. In other words, if the CPA wants to lower sampling risk, the risk that the sample is not representative of the population, the auditor would increase the sample size. This makes sense. To decrease your chance that the sample does not represent the population, simply sample more. If the auditor can accept more sampling risk, then sampling risk increases and the sample size decreases. The smaller the sample size, the greater the sampling risk. Increase the sampling size and the sampling risk will decrease. Note, this is an inverse relationship. When sampling risk is high, the sample size is low. When sample risk is low, the sample size is high. There are two types of sampling risk for tests of controls. One, the risk of assessing control risk too low. And two, the risk of assessing control risk too high. If you had to make a mistake, which one would you rather do? Based upon the results of your sample, would you rather assess control risk too low and say that based on your sample, control risk is low, thereby relying on the controls and decreasing the substantive tests? Or would you rather assess control risk too high and say that you must assess control risk high, therefore increasing the amount of substantive testing? I would rather assess control risk too high. In this case, yes, I will spend additional time and do more substantive testing, but eventually I will come to the correct audit conclusion. If based upon your sample that was not representative of the population, you thought the internal controls were operating effectively when in fact they were not, you would erroneously conclude that you could reduce the amount of substantive testing. You could actually miss material misstatements in the account balances and go on to issue an unqualified audit opinion. This is a disastrous situation for an auditor. If based upon your sample you assess control risk too low, you could conduct an ineffective audit. On the other hand, if based upon your sample you assessed control risk too high, you would not be ineffective. You would just be inefficient. Remember the following. There are two types of sampling risk for tests of controls. One, assess control risk too low, and two, assess control risk too high. Assessing control risk too low affects the auditor's effectiveness. Assessing control risk too high affects the auditor's efficiency. I would much rather be an inefficient auditor than an ineffective auditor. Of course, I don't want to make any mistakes. It's the auditor's hope that their sample is representative of the population. Now, for a very important attribute sampling is a method the CPA uses to sample for tests of controls. What about the testing of the dollar account balances? Recall from Module 3, Audit Evidence, CPAs use substantive tests to test the dollar account balances. The type of sampling used to test dollar account balances is known as variable sampling. Don't forget this important distinction. Attribute sampling methods are used for tests of controls. Variable sampling methods are used for substantive tests. There are two types of sampling risk for substantive tests. Variable sampling. One, the risk of incorrect acceptance, and two, the risk of incorrect rejection. Which mistake would you rather make? Would you rather, based upon the results of your substantive tests, incorrectly accept the dollar balance or incorrectly reject the account dollar balance? This one is easy. You would rather incorrectly reject the account dollar balance. To incorrectly accept the dollar balance could lead to a lawsuit. If the account balances are incorrectly stated, it means the balances contain material misstatements. If you attach an unqualified audit opinion to a set of financial statements that are materially misstated, you could be in great trouble. On the other hand, if you try to incorrectly reject the financial statements, the client will ask you to explain your findings. Upon explaining the findings, you will discover that your sample was not representative of the population. Therefore, it could not be taken into respect of attribute sampling. The objective or purpose of attribute sampling is to estimate the rate of deviations from a control procedure or policy. For example, if a client has a control requiring 2 signatures on all checks written that are greater than $50,000, a deviation from the policy would be a check written for, say, $50,300 that has only 1 signature. What would the population be for the above attribute sample? The population would consist of all checks written during the year that were greater than $50,000. The sample would be some of the checks from the list of checks that were greater than $50,000. The pertinent control would be 2 signatures by company officials. The financial statements assertions tested in this test of control might be completeness and valuation. Recall from Module 2, Internal Control, that all tests of controls must be linked to one or more financial statement assertion. What would make the auditor happy here? The auditor would be happy if the selected checks, all checks, contained 2 signatures. The auditor would be unhappy if some of the checks contained deviations from the control procedure, or in other words, if some of the checks greater than $50,000 had only 1 signature instead of 2. So in the above example, we have defined the objective of the test: to estimate the rate of deviations from the procedure. The deviation is defined as a check in the amount of greater than $50,000 that does not have 2 signatures. The population was all checks greater than $50,000. The period covered by the test would be the months tested. Recall that tests of controls are usually performed at interim. Therefore, most attribute samples do not cover the entire year. Tests of controls are performed on the entire year only when personnel or circumstances have significantly changed since the controls were last tested.